If you think that you're working hard because you're working a 9 to 5 and you did 40 hours a week, you're lazy. That is not you working hard. That's just you working.
But the difficult part is, right, how many 20-year-olds are being taught that?
There's no way our kids will be able to afford a house 10 years from now. With the way inflation's going. Yeah. I'm 42 years old.
Dang.
I know, right? At least I'm Asian, so I don't crack. So at 42, if I can go back and give myself advice when I was 18, going into the real world, after all my losses, and sometimes I gave up, and the things I wish I didn't give up on, and if I didn't give up on certain things in my life, I think I'd be so much further ahead. And the advice I would give myself is to give myself a chance. So today we're on our Give Ourselves a Chance podcast, and we're going to give ourselves a chance to be winners and not give up when we see hard times.
I love that, dude. Such a good one. So guys, today we have a very special guest. We're going to go into who he is and what the content is going to be around in a second, but don't want to overlook some of our favorite things. And so I'll start with mine. I brought you some of this as well. Dane, I'm not sure if you're a mezcal fan. Are you a mezcal fan at all?
Occasionally.
So mezcal, for those who don't know, it's very similar to wine, right? Different types of grapes will impact the type of wine that you have, and the same way that varietal principle is what mezcal has too. So the type of agave really impacts the flavor. This is a papalote, which is one of my favorites. And so you have your own little copa, which is a traditional way of drinking mezcal. It's not a shot glass, it's just their glasses, so you sip it if you want. But I wanted to bring this for you to share. But man, sell us on what your candy is.
In this assorted pack, so it's like before they were clear wrappers, so you knew what you were getting. Nowadays it's just a golden one, and you don't know what you're gonna get.
Yeah, I hope you got a good one this time.
Yeah,
not black licorice. Dane, cheers to you, man. For anybody here, I think the best way to describe you is you're someone who is intricately involved in businesses. You see them grow. You give it guidance on how to be able to be even more successful, how to start, how to finish, how to exit, which is why I thought you'd be such a great guest, just around money, around success, around business as a whole. I think a good first question to start off with is when you're analyzing businesses to invest into or ones that have potential of growth, what do you look for?
When is the juice worth the squeeze?
Yeah.
One of the primary things that I noticed by going to conferences and asking a lot of questions was their integrity around their answer. I'll give you a quick example. And you guys being in the mortgage and real estate realm, you know about cap rates.
Yeah.
So I got flown out to these conferences, lots of different private real estate groups. And when I would ask about what their average cap rate is. And by the way, cap rates are obviously different in lots of different realms, whether it's healthcare, real estate, or apartment complexes, storage units. And when I asked them their average cap rate that they're acquiring properties at, I found out that a lot of them used a cap rate that was averaged over the next 5 years of projections. When I would use the word current cap rate, that was the rate they would still use. So I didn't like that they were putting their best foot forward on projections versus my question was current cap rates, because I'm asking about what the market is now.
Yeah.
And that distinguished to me the different management groups that I wanted to use versus the ones that couldn't answer the questions about around fees, about cap rates. I was like, I don't want to do business with those companies, but companies that weren't trying to
be too optimistic.
Exactly. I want the actual information.
Yeah.
That way I can help my clients make the best decisions, not the fluffy answer where potentials are going to be.
Yeah.
And so that was definitely one. And then the others would come down to different business types. Obviously there's lots of different businesses and different asset classes.
Yeah.
And I have to kind of allocate those for clients. So that would be another. And then profitability from there. So
yeah.
So you brought up profitability. If you don't know the industry, how do you judge it? Because sometimes, if it's a business that let's say when bagel shops were hot and you're riding that train, well, it's a good time right now because bagel shops are hot. Like there was a season where it's like people were popping up bagel shops like crazy, and then yogurt shops. Remember there was a season where yogurt shops, pink berries were just exploding up. Like when it's a different industry, or okay, I want to invest in this business, but you don't know the industry. You just do the numbers, or like what allows you to see some potential at least?
So to answer your question, I'm not picking the bagel shop or the pink berry or everything, but I will give you an example of one, maybe actually the 4 primary alternative investment funds that I use in 2022 were all positive, somewhere between about 3 to 10%. And the one that's the private equity, CNL, they have Levine Lechtman. That's all they do. That's all they do is just private equity buyouts. And so they have, like, for instance, the Lawn Doctor. I don't know if you guys have heard of the Lawn Doctor, but that's one of the ones in the portfolio. So that's what they're picking on a specific basis. So we are using those for, you have a whole world of team behind that portfolio rather than me just picking each one of those.
So you have a bunch of, like, you have
advisors?
Yeah, pretty much.
You have a ton. I mean, you have between 50 to 100 economists, managers, and everything behind even one position per. So yeah, that's how.
Now, just so people who listen here can learn, and also for me to learn, anybody who's new to this world, right, and have no clue even what private equity is, right? Can you break down what that looks like in a practical way and how to understand it in a simple format?
If you are just in a turnkey model of, call it 70% stocks and 30% bonds, and that's your model of how to bring value to a client, you're a dinosaur, and you're going to be losing more and more business all the time. If you're very detailed in adding value add to your clients, and there's, I would say, kind of almost two primary dividing lines in that. One is going to be detailed oriented in the tax planning side. You're bringing huge value to your clients and helping them save taxes. And I see inefficiencies every day, all day long. So to be detailed in that is very important. And then the other part is different portfolio construction. If you don't look at how the top institutional endowments, institutional managers are managing money, it's not a 70-30 model. They're adding a ton of alternative investments because you're looking at different market cycles and they act very differently. So you're really smoothing out, you're having same long-term returns, if not a bit better actually, because you're not participating necessarily in these huge downswings by adding these alternatives that don't act that same way in a downturn.
So we're looking at somebody's financial portfolio, right? We're talking about 70-30. Your money, where is it at? It might be 70% bonds, 30% stocks, whatever. What you're sharing here, if I'm understanding it correctly, is there should be a portion of that 100% makeup that goes into alternative type of investments. Is that correct?
That is my that is my personal opinion.
What is alternative investments? Like, what does that mean?
Good question.
Yeah.
That's exactly what I was going to say.
I had a feeling.
What that is. Investments look like private debt, private equity, real estate, infrastructure.
Give us an example of private debt or private equity.
Yeah, I actually, this year is a beautiful year for private debt, quite frankly. As we all know, not necessarily the best time in history to be a borrower.
Yeah.
But what if you're on the other side of that?
Yeah.
What if you're a lender? So to be a private debt investor, you're on the other side of that. Private debt, the majority of it is floating rate. So in a rising interest rate environment, it's done very well. It's different. You guys all have heard of bonds.
Yep.
Bonds are an IOU, right? A loan or a private debt. Really, most of them are private loans. Loan is an IOU, and if you don't pay, I will take that asset.
Yeah.
So there's an extra layer of safety net. Now, there's also many different aspects of what types of safety nets. So don't understand this by saying it's safe. That's not what I'm saying at all. And by the way, you should be in a diversified manner in these. So you want to be very diversified in those regards. But I'll give you a quick example of first position or second position loans and why they can be great versus a bond. You guys remember when General Motors went bankrupt?
Yeah.
All right. So if you were a stockholder, you got wiped away, right? If you were a bond holder, you got 22 cents on the dollar. Still not good. Yeah. If you were a loan holder, you got 100 cents on the dollar. Because when there's a capital, in a liquidation or a bankruptcy of company, you have a capital structure. You always want to be the first person in the buffet line, right?
Yeah.
I personally do.
Same here.
Yeah.
Especially when the days they have like all you can eat lobster, you want to be first.
Exactly. So that's a good position to be in. And loan holders are paid first, and then it goes down the structure. And the reason why General Motors, loan holders got paid first is because it's backed by real assets. You have the factories, you have the steel, all the things that are assets that can be sold. Kodak was another example. When Kodak went bankrupt, the intellectual property was an asset that could be sold. In fact, those loan holders made a profit when they went bankrupt. So loans can be a really good piece of the portfolio if done properly, if using the right managers and in a diversified manner.
So you're not talking about like you guys, or not you guys, but that private loans are just you found an opportunity, somebody needs some money, and you're issuing it on a one-off. You're talking about like big.
These funds are $3 billion to $12 billion funds, and they're underwritten by Wall Street, and they're using companies that have EBITDA between on the low end probably 50 to 300 million. So they're real assets, and oftentimes they cross-collateralize the balance sheet. So it's not just this one debt for this one asset. In other words, if it comes like
it's a blend.
We get first pick at whatever we want.
So then bringing that back to kind of person scenario, everyday person, and then hire successful people. I'd love to kind of hear that. What was, from your experience and everything you've been exposed to, what would you give the guidance of somebody who isn't there yet, right? They're in their 20s, they want to be able to grow, they don't have a portfolio to even try to manage. What would be their advice to the other end, like the super successful people? Are you pretty much just a multiplier of the fundamental success they've had? Like you take the success they've had and then you help multiply it from there on out?
Yeah, really good question. So I'll do the multiplier first just because that's a little bit shorter. The answer is yes. They have a great foundation. Yeah. And here's the thing, to take what they've done and be able to enhance it that much more is really neat. But we're talking, especially with the successful, they run into issues of major tax situations. You guys have heard of death taxes, also known as estate taxes. For the first, call it 24 million as a married couple, you're exempt from death taxes. If your estate grows above that, you could be subject to upwards of about 40% in taxes.
Such a big number.
So let's say you own a business, a family business, and it's worth, let's say, 100 million. And so again, let's just round up to make the math easy. 25 million we can exempt. 75 million would be subject to almost 40% in tax.
Wow.
Who's going to write that check to the IRS? So that becomes huge value of having a really good team. And by the way, most people, once they reach that level, do have a good team. But what about the people who have 20 million, 30 million, 40 million? That really may not have that good team in place. So passionate about it, yes, and there's millions and millions of dollars that can be saved there. Yeah. To kind of compartmentalize that, that's a lot of what we do in that regard. And to be able to have that kind of mentality that we have now of what can I do better to get ahead, you really don't have to do much. It's very little. It's just, are you going to take those little steps, or are you going to be a part of that crowd that's wanting to maybe go out and spend a lot more money and do what everybody else is doing? Are you going to have that discipline to do just that little bit now to get you ahead later? One of the big things that I love is the Roth IRA for the 15, well, you can even do it younger than 15, but as long as you have earned income, what is that, right? 15, that's babysitting maybe. Chores or what's...
my son holds my camera for me, so I give him $12,000 a year.
You should.
And I take the $500 to go into his Roth, and then the rest I put into an IUL.
I love you. Could have been the sexiest thing I've heard in a month. In a Roth, exactly. And by the way, you already know. I think it's $12,950. Under that, you do not have to file a return, as long as you just keep that ledger of that time.
I deducted off of my $12,000, so I pay $12,000 less.
Yep, you get a deduction. Right. So he already knows that you have.
Explain it to everyone else.
Yeah, and you've put your son so far ahead. And by the way, if you basically contribute that $6,500, max out his Roth for 15, 16, 17, and 18. Just 4 years. And let's say your son never contributes again in his life. With an average of 8% annual return, he will retire with $1,090,000 and change. I think it's $515.
Yeah. So for me, we did the math so we started it by 35 when he buys a house. He can pull out his contribution, which is I think like a couple $100,000 to buy his house. If he at 25 or at 35, if we never touched it again, he would have 3.5 just on the compound on 80% interest.
Yeah. So and that's a lot of. I don't necessarily go into all that people can pull out of the Roth and stuff like it's almost like
the down payment, because if I do it now at 35 when I think when my time to disappear, that he hasn't, I don't have to think about his housing, because you think about there's no way our kids will be able to afford a house 10 years from now. With the way inflation's going, the amount of money we print.
I know. So, and you're talking, the reason why he would have that 3-4 million is he continues to contribute to it. And the reason why that's so important at a young age is when you get older, if you're in a higher tax bracket, you're going to need those deductions for a deductible retirement plan, which a Roth is not, right? And oftentimes people phase out. Myself, a lot of my clients, we cannot contribute directly to a Roth, but I am a huge advocate of doing the backdoor Roth with them.
Man, what has been super helpful for me is to be able to understand that if I see that the government has created this game plan of their rules, right? They created a rule book for their game, right? And you realize the way to win is to win the way the government wants you to win, i.e. follow the rules of the tax code and understand that there's loopholes there to just be able to help you. Once that clicked for me, I was like, oh, dude, now I embrace tax strategy, and realize that this helps. It's a cheat for me to win the game. And so that's been super, super helpful. And to go back to that original question of like, what would you advise that person first coming on, right? That person who's not successful yet young, you hit it so well. Find opportunities to be able to keep more of your own money, but then what do you do with it? Because that's the thing that people mess up on, right? They find opportunities, they have a tax refund, they have a tax break, and then they're paying for the tables and they're spending money. And the next day they've totally forgot how much they spent. The next month they see their bill and they're super pissed off. And so what would you give guidance there and tips from your experience?
It's a good question you ask. I think it's so kind of apropos in this, considering 2020 to 2022, for this young age group who was so eager, gung-ho on what they thought they could become rich really quickly with,
I think in youth you have to also you feel fearless when you're young and you don't think that in the future, things might happen where you might need that money.
Yeah, you're like, F that future self guy. He's going to be great.
I've been doing this about 21 years now, and when I hear people say it'll never, not, or always, like I heard this in 08 in real estate always goes up. The answer is oftentimes yes, in many situations, yes. But they were banking on terrible math, right?
Yeah.
Negative arbitrage. I'm going to borrow from the bank at 6% and my renters are going to pay me 3%, negative arbitrage, right? So really good fundamental math is a good foundation to start with, but also cryptocurrency is an example of irrational exuberance. We saw this in the early, I would call it the late 90s, early 2000s, right? With companies that just were... It was just .com. It was just the internet. There was no business model.
Yeah.
And we saw that in the cryptocurrency again. We saw that with the GameStop, all these things. So my
forgot about GameStop.
Yeah.
Such a
it's just these valuations are crazy. So here's the thing. Do not get this high blood pressure, euphoric feeling. That's a big my job continuously is to help people separate themselves from their emotional reaction to money. That is what I do all day long.
Dang.
Let's stop with the emotional reaction to money and let's make sound financial decisions. And let's stick to that plan. And we're going to look at different market cycles and find out what your reaction will be in advance. So I'll do a simulated portfolio based on the risk reward or the risk objectives, goals, tax bracket, and I'll walk them through that. In this market, this is what I've done. Are we going to sit through that, or are you going to bail at the exact wrong time? So in other words, we've already had that conversation of what may come down the road, right? Mm-hmm. I feel like a lot of advisors don't do that. It's just, hey, this is what you should do. And then 3 years from now, you have a market cycle that creates a problem. So if we can create that, taking out that emotional aspect now with sound fundamental investment, that really could be something good for somebody who's young, who can stay the course then.
Yeah.
Exit out of the emotional aspects when things will get rough, because the markets will be. Diversify in a good manner. Those are and continuous contributions and revisiting that plan. I think those are the fundamentals that really can help. Everyone started with the risk on, with the I'm going to get rich really quickly, with this GameStop options leveraged and this and that, and therein lies the problem, right?
Yeah.
I have my foundation.
Yeah.
And that is what I would encourage a lot of people. Create your foundation, create your plan, and as you want to add risk, think about that risk of to what degree do I care if that risk goes down 30%? What about 50%? What about 70%? What about it gets wiped out? I did some crypto myself, but my mindset the entire time was
I don't care.
I don't care if it goes to zero.
Yeah.
This is literally, if it goes up, great. If it goes to zero, it's not changing my foundational plan of retirement. So.
One of the fun things that I realized with mine too was it also put pressure. It's like, okay, I'm worth X amount if I die. I better keep making sure for my wife that I'm making more as I'm alive, because if not, I'm going to be better dead to her. And that's going to put me in a bad spot. I'm not going to be able to sleep with both eyes closed.
So I think having that backstop, where most entrepreneurs don't think about it, because they're in their early 20s and they feel invincible. They feel like they can walk on water. They can catch bullets with their fingers. And when that bullet finally hits, they don't have anything to fall back to. And I think that's why a lot of entrepreneurs, they lose so much and then they'll get it back.
Yeah.
But if you cannot lose, of course, that would be the biggest, win for your kid. If you tell your kids, hey, if you want to avoid losing, set up these backstops so you can, embrace the challenges and the changes.
I mean, you got some too, right? I know you're really interested in
I'm
this.
really processing a lot of stuff he's saying right now. And a lot of stuff where the investing, it's a mindset thing. It seems like it's all about mindset. Position yourself, because you can't always win, which I'm learning, but you're positioning yourself to have the right mindset. So if you lose it, you don't care. So I'm just processing everything he's saying about investing, because I'm thinking about my day trading, like hearing what he's saying, and I'm just trying to say it's the patience. It's okay. It's probability. There's not always a win. And every entrepreneur thinks they are invincible. They're always going to win. And when you think that way, when you do take hits, it does affect you mentally, because if you play on probability, okay, there is a chance I'm going to lose. Then going to the next investment, you're not skittish and you're not afraid, because you're playing a probability, not playing an absolute.
Yeah.
And as you're doing that, my day trading mentor is like calling me, because I had 4 red days. I started about a year ago. For the last 4 months, I've been green. I've had 4 red days. And every time I've gone red, I've gotten worse and worse, because I thought I was invincible. And because I didn't play the probability that, hey, you are going to lose. So the next day I traded, I jumped out the trade even sooner, because I'm in fear. So that's what I'm learning.
Yeah.
That's I would say the difference between day trading and long-term investment strategies.
If you think that you're working hard because you're working a 9 to 5 and you did 40 hours a week, you're lazy. That is not you working hard. That's just you working, And so I think about like a perfect scenario, and, if somebody is doing a side hustle on top of that 40, right? And they're doing Uber on the side or whatever type of hobby type of business piece they have going, man, if I was back then and I did a side hustle, I think I'd take that money and either take the long-term route and just invest it, or split it, invest half of it, and then day trade the other half until I have enough money as well to start going into real estate. Real estate for me is one of my jams. Like, I love being able to see real estate investment. And so I would definitely be utilizing that. But if you're at a young age, I mean, you have so much opportunity in front of you. And one of the biggest opportunities you have is not the currency of money. A lot of times it's the currency of time.
It really is.
I think people definitely misvalue that. Yeah.
It is one of the biggest things. But the difficult part is, right, how many 20-year-olds are being taught that?
Yeah.
Where's their resource coming from? And by the way, I would say now more than ever, because they have access to podcasts and things online. But a lot of it starts when they're young at home, being taught their relationship with money. And I mean, your children are going to be set up well, because you guys will teach them that. And also where that comes from, kind of even back to what you're saying, those day trades, it goes back to your values as to why you're doing what you're doing.
Yeah.
One of the neat parts of what I do is that's where I start with a lot of clients, is uncovering their values as to why they're doing it. Because everyone has different values as to whether that's charity, family, security. But what you're taught, your relationship with money, is very important.
Any closing remarks?
Yeah, wisdom. Define your values around investing. Invest in a continuous manner. Find somebody that can help you with the details, to be honest.
Yeah.
That's your team. Whether that's a tax attorney, CPA, financial advisor.
Yeah.
Make sure they know those details. So those are kind of some good foundations to get started. And early, when you're young, for sure.
When you're looking at giving yourself a chance, give yourself a chance to be wise, and don't just worry about giving yourself a chance to try to hit that lucky money.
Yes.
Believe in yourself enough that you're going to care for your future self, set your fundamentals, have your backstops, and then enjoy having a lot of fun and endeavors to try to hit the success. Sweet.
Yeah.
All right, guys.
Thank you guys for having me.
That's
Appreciate
great.
It. Way fun.